Hi, I'm Peter Rose, founder of Longwood Currency Trading. I want to do a cautionary video on reverse staging. Over the last few months, I've had several emails just asking me questions about reverse staging. And recently I received an email from someone who was commenting on a video from about 10 months ago. I thank you very much for your email and for taking the time to write to me in detail about what the situation was. I was at dinner with my wife and I had some pending orders set, and my phone clicked off indicating that the orders had gone through. Prior to going to dinner, I was about $1,000 behind on that particular trade, and I think I ended up making $4,000. So the person was questioning me whether the pending orders were being staged in or being reverse staged. And some of you don't even know the difference between that because it's an advanced topic. And this particular individual, and again, I thank you for sending me an email and letting me know that you weren't a trader, a practicing FOREX trader, but you were asking these questions because, and I will write you back. I wanted to get to this video right away because you brought out a very important point, and I will respond to your email, and I hope we can have some communication from that point forward. But this is a cautionary video about this topic about reverse staging. Reverse staging is, let's say you were going long on a position, and to stage into the position means that as price moves forward, in other words, up in an upward direction, you add lots as it goes up. Let's look at the same situation where we have a profit target that is a long profit target and that will need to be staging in as that price moves forward. But instead, the price either on entry when I kick an order off or maybe after one staging position suddenly turns around and starts going in a negative direction. Again, this is a long position profit target. I've got a position on and the position turns against me and moves into negative territory. If I start adding lots, which would be better known as averaging down, if I start averaging lots as the price moves against me, what that does is two things. First of all, it makes the loss bigger. Second of all, because you're staging those lots in a reverse order and have a set stop point where you go, well, I'm just going to get out. Let's say that you have a 20 pip and the only way you can do this reverse staging if you have 20 pips that you're dealing with. You're not going to try to do that short stacked at 5 or 10 pips because you're just compounding a miserable situation. The theory behind reverse staging is that if you've got a 20 pip stop and its price is moving against you and it moves 10 pips against you, you would add some lots to that position. So if the position goes to the 20 pip stop out point, those last lots that you added in only cost you 10 pips, not the full 20 pips. If the position turns around after that reverse stage at 10 pips and then goes forward to the where your average position value is at that point, now you've got a positive position of 10 pips or whatever it is because you did the reverse stage. And if price keeps moving in the direction, now instead of your profit being measured from the entry point, it's measured from the entry point plus 10 pips less than that. In other words, let's say you go 10 pips into profit, you've got 10 pips of profit from your entry order, and you have 20 pips of profit from your reverse stage. It's a wonderful thing. This is an advanced topic. And you guys that have less than a couple of years of trading shouldn't be even thinking about it. I don't teach it in any of my courses, except I do mention it and talk about it in my Advanced Solutions course. And nobody takes that unless they're an advanced trader. The reason for that is because so many things can go wrong if you're not experienced in that. And it can cost you a lot of money if it whipsaws you. I've probably lost larger amounts of money in reverse staging situations than I would normally lose in just taking a stop loss, or position goes against me and I refuse to get out and hold it 8 or 10 pips too far. The major danger here in reverse staging is that you reverse an ad at the wrong point based on the price action at the time. You have to be very well aware of price action and what its probabilistic characteristics are going to be in that one particular instance. You can't put reverse staging into your trading plan as a thing that you do every time the price goes against you. Now, there are traders out there who that's what they do. They reverse stage. They have a lot of confidence in their trading. They have a profit target where they just dump out the whole thing, and they'll stage in 3 or 4 times. But they're doing that with very small amounts of money, and they're very experienced, and their win rate is very high. So if you don't have all those characteristics, you shouldn't be doing it. And I've determined in my own trading, and I've been looking at the currency market since 2007, I've been looking at my own trading results and things, and it's not that I would never do reverse staging, but I would be very, very selective about doing a reverse stage, and would probably only do that maybe once a month or once every 3 months or something like that. I've kind of, in my own head, sort of determined that that just isn't something that I should be doing from a mathematical standpoint. And that's, I mean, you can work the math out. I've got the math all worked out as to exactly how to do that. But the math in this particular instance is immaterial unless all of the conditions are lined up and you get lucky. Or you are one of these extraordinary people that really have this tremendous ability to judge when the price will ultimately end up going in the direction that your entry analysis sets up to where your profit target is going to be. In other words, if I'm really, really, really good at entry analysis, which is a really advanced person, then they have no fear of reverse staging, because there's an 80% chance that the price will turn around and go in their direction, and they're going to make a lot of money as a result of that. I can't caution you enough as to the delicate nature of your position if you reverse stage. And I am very concerned at this point in my own trading about doing a reverse stage, because the consequences can turn out to be so bad, so catastrophic. You get wrapped up in the trade and you don't get out when you're supposed to get out, or you get the staging process wrong and it goes in your favor and everything is working out, and then you turn it around and the price starts to go back against you. Your average price value, your average position value is so close to where the current price is, that could turn around and go 10 or 15 pips against you on a pin bar, and you are catastrophically in trouble if you're trading large lot size positions, as I do. It just isn't worth the aggravation to do that. And so my caution to you is, if you're not a really advanced trader and really have really good entry feeling about your positions, then you really shouldn't be doing it. My feeling is that the only thing I have control over, or that I'm sure about, is my loss. I can set that. I can have no expectation of how much money I'm going to make, or if I'm going to make any money, other than a wild-ass probabilistic guess. And that's certainly not a sufficient enough basis for involving yourself in reverse staging a position. It's just not. I think someone who can do that is unique and not the norm. When you look at entry analysis the way that I do, it's that vague probabilistic thing is, oh, it may get there. If you get so set without having the background for it, that this is your profit target and the price is going to move in that direction, and it doesn't, and you start doing this stuff, your brain is going to take over and you're going to do crazy shit. I just guarantee that you will. This video, if you pay attention to it and don't reverse stage, just take it out of your brain totally and forget about anybody who's saying that entry analysis isn't important because that's the easy part, the hard part is getting out, or all the other stuff that you do in position management. They are grossly wrong, or they are far, far ahead of the rest of us in their ability to judge entry positions. Entry analysis is basically a probability, and that probability is based on certain key trading metrics that you as the individual trader develop, and you have to correlate those individual metrics with your probabilistic expectation of during entry analysis as to where the profit target is and what your likelihood is that you're going to be able to achieve either the profit target or some part of it, let alone having a trade that's going to end up being a runner. So to summarize for the 14th time, nobody should be doing reverse staging. 99.99% of the time you shouldn't be reverse staging. However, there are conditions, advanced conditions in my mind, where you may want to do that. So if you are an advanced trader, not a beginner, then you may want to look into setting up a set of rules for that are external to your normal trading rules. And then when you enter a situation where the likelihood is very strong that your profit target is really solid and that any retracement would be just that, then you've got some rules to deal with that. And I will caution you that those rules are different than what I call the life cycle of a currency position, which is entry analysis, position management, and exit methodology. And each one of those phases of the life cycle of a currency position is a problem, and each one of those problems has a series of a very small series of sequential conditions that need to be met in order to execute those rules. There is no condition or any accounting in those rules for reverse staging. There are conditions that allow for operation for a runner. The conditions are conducive for correct staging, but if you're going to stage, you can't just say, I'm going to stage in. You have to understand the math of the staging. I've written computer simulations that run hundreds of thousands of iterations through a large matrix of varying parameters, in order to determine what those mathematical relationships are as to when you would stage, how many pips there are between your last stage and the next one, and how many lots. It's a very difficult problem, a very complex problem to solve. You don't just go and do, in real time as your position is moving in your favor, go, oh, well, this is going good for me. I think I'll throw another 3 lots against that. That isn't the way that it works. You can't do that. And when I do it, it costs me tens of thousands of dollars. It just cost me that the other day. 10,000 bucks. Because I got it wrong. There are certain things that you can write rules and conditions for, and certain things that you have to have the experience to make judgment calls on. Well, let me tell you, reverse staging shouldn't even be in your repertoire. That would be my advice to you. That's all I can tell you on this. And I've talked too long about it. You either believe me or you don't. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.